Well, there's been a lot of talk lately about gold, about whether it still matters, whether it's just another crowded trade, whether it belongs in museums instead of modern portfolios. So in this video, we're going to separate signal from noise, and you're going to walk away feeling a lot smarter and a lot more confident about what money actually is. It is Tuesday, April 14th in New York, so go ahead and comment the day and date you're watching from. And if you value this kind of content, subscribe and comment John A.G. Best, so I know you want more of these. Because here's the mistake almost everybody makes. They hear the word gold and instantly think investment. They think price target, they think trade idea, they think shiny rock that does nothing. But the deeper question is not whether gold had a good year. The deeper question is what exactly counts as money, what gives money credibility, and what happens when the thing doing the measuring keeps quietly changing. Now, when you zoom all the way out, something very strange shows up. Civilizations that never shared the same schools, never shared the same politics, never shared the same technology, kept circling back to precious metals, and especially gold, when they wanted durable money. That doesn't mean every monetary system was identical, of course not. But it does mean humanity kept discovering the same lesson from different directions. Gold lasted, gold traveled, gold could be divided, and gold was difficult to create on command. That last part matters more than people realize. Because most of the financial world today is built on promises. Some promises are productive and useful. Businesses can create value. Bonds can pay income. Real estate can generate rent. I'm not knocking any of that. But gold is playing a completely different role. It is not a business. It is not a coupon. It is not a management team with quarterly guidance. Gold is closer to a measuring stick than a machine. It doesn't need to impress you with growth. It just has to remain stubbornly scarce while everything around it becomes easier to manufacture. That's why I think the phrase that matters here is not gold is going up. The more important phrase is, what is the currency doing? And once you look at it that way, the story changes. Paper money was not originally designed to be the whole show. It was supposed to be a claim, a convenience layer, a more portable stand-in for something harder and heavier. Fine, that made sense. But once the stand-in stops being tightly anchored, once the leash comes off, then the entire discipline of the system depends on the people running it. And that is where the plot thickens in a very serious way. The turning point, of course, was the early 70s. Under the Bretton Woods framework, the post-war system centered on the dollar, and the dollar itself was tied to gold. That arrangement was formalized in the mid-40s at a conference attended by delegates from 44 nations in Bretton Woods, New Hampshire. It created stability for a time, but it also carried tensions inside it. Too many dollars abroad, too much pressure on the gold link, too much strain building beneath the surface. Then, in August of 1971, the convertibility link was cut, and the modern Fiat era fully took over. Now, let me be careful here because this is where people get cartoonish. I am not saying every economic problem since then came from that one decision. That would be lazy. Oil shocks mattered, demographics mattered, productivity cycles mattered, regulation mattered, globalization mattered, technology mattered, human beings being human definitely mattered. But it is also obviously true that removing a hard monetary constraint changes behavior. It changes incentives. It changes politics. It changes how easy it becomes to bridge every crisis, every war, every recession, every panic, and every election season with more balance sheet expansion. And once you understand that, you start seeing inflation differently. A lot of people think inflation is just prices going up for mysterious reasons. Groceries cost more, rent costs more, insurance costs more, cars cost more. Fine, that's the surface. But underneath that, another thing may be happening. The measuring unit itself is losing integrity. The ruler is changing length. Your labor didn't suddenly become worthless. The unit used to store that labor became easier to dilute. That is why savers so often feel like they're running uphill even when nominal numbers get larger. From recently released inflation data, the All-Items Consumer Price Index in the United States rose by 3.3% over the 12 months through March, up sharply from the prior month, while the core measure rose 2.6% over the year. Energy played a huge role, with gasoline making a dramatic jump during the month. That doesn't prove runaway inflation forever, but it does remind you that the story is not settled, and the purchasing power problem is very much alive. At the same time, the federal debt picture keeps getting heavier. The Treasury's own fiscal data now puts the national debt just under $39 trillion, and broader debt reporting continues to show a system carrying an enormous and growing load. Again, this does not mean an instant collapse. It does mean the monetary backdrop is increasingly fragile, increasingly political, and increasingly reliant on confidence holding together. Confidence, ladies and gentlemen, is the word, because fiat systems can function for a long time. They can function very well, in fact. The issue is not whether paper money works in the short run. The issue is what happens over long stretches when the guardians of the unit face constant incentives to make more of it, finance more with it, and rescue more with it. The damage is gradual, which is exactly why most people miss it until it is obvious. And that brings us back to gold. If gold were truly irrelevant, central banks would treat it like a museum piece. But that is not what they are doing. According to official reserve analysis from Europe's central banking system, the share of gold in total official reserves rose to about 1/5 at the end of last year, moving above the euro's share at market prices. The same report noted that central banks added more than 1,000 tons of gold in the prior year. That is not fringe behavior. That is the behavior of institutions that think in decades, and the trend did not just vanish after that. Gold market research published this year showed that overall gold demand in the most recent full year exceeded 5,000 tons for the first time, with investment demand surging and official sector buying remaining historically strong. Central bank purchases in that year came in below the extraordinary pace of the previous 3 years, but still landed far above the average of the decade before the buying wave began. In other words, even at record prices, serious institutions kept showing up. That should get your attention. And here's another fresh layer people overlook. In the United States, gold demand last year surged by roughly 140%, driven heavily by inflows into gold-backed funds. So this is not just some vague international reserve story. Large pools of capital inside the U.S. market also moved aggressively toward gold exposure as geopolitical stress, rate uncertainty, and a rising gold price all collided. Now, why would that be happening? A few reasons seem pretty obvious. First, diversification. If too much of your savings, whether national or personal, sits inside one political system, one reserve currency, one bond market, one promise structure, then you are more exposed than you think. Second, sanctions risk. When countries watched roughly $300 billion of Russian central bank assets get frozen in the West after the invasion of Ukraine, that was not just a Russia story. It was a reserve management story for everybody else too. It was a reminder that not all reserves are equally sovereign. Third, debt and geopolitics. Survey evidence from the central banking world shows concern about geopolitical tension has surged, and a large share of reserve managers expect global dollar holdings to decline over the next several years while gold's role increases. Notice what that means. It does not mean the dollar disappears tomorrow. It means the margins of the system are shifting, and gold is part of that shift. And if you want one more clue that this is not some fringe obsession, look at how reserve managers themselves are talking. In the latest central bank survey, the overwhelming majority of respondents said they expect global official gold reserves to keep rising over the next year, and a record share said their own institutions are likely to add more. They also pointed to crisis performance, diversification, and inflation hedging as major reasons. That tells you gold is not being treated as a nostalgia piece. It is being treated as strategic ballast. There's also a practical trust angle here that doesn't get enough attention. The same survey showed more central banks reporting some domestic storage of their gold. Think about what that says. Location matters, custody matters, access matters. In quiet times, these things sound technical. In tense times, they suddenly sound very important. Gold is one of the few reserve assets where custody itself becomes part of the thesis. Now compare that with the broad money backdrop. Federal Reserve data on M2 still show how much the monetary landscape changed during the pandemic era. Money growth surged to extraordinary levels, then cooled, but the system did not simply snap back to the old world. A much larger pool of money remained in the plumbing, and inflation followed with its usual lag. That does not mean money supply charts explain every move in prices. They do not. But they are one more reminder that modern monetary systems can change size much faster than physical scarcity can. Gold does not have that problem. And that, by the way, is why I think the old argument that gold just sits there is weaker than it sounds. Yes, physically it sits there. That is exactly the point. It sits there while governments change, while policy regimes change, while currencies get redesigned, while debt piles up, while reserve managers rethink exposure, and while markets swing from complacency to panic and back again. Gold's stillness is part of its function. In a world addicted to intervention, an asset that refuses to be easily multiplied has informational value all by itself. It also has historical value. One reason gold keeps surviving intellectual fashion is that it forces humility. It reminds you that very sophisticated societies are still capable of weakening their own measuring unit over time. They can hide that with growth for a while. They can hide it with asset inflation for a while. They can even hide it with strong nominal wages for a while. But purchasing power has a way of telling the truth eventually, and gold has a way of exposing that truth earlier than most people are comfortable with. And this is where I want to challenge one lazy idea from both bulls and bears. The lazy bear says, gold does nothing. That's too shallow. Gold does something very important. It reveals stress in trust-based systems. The lazy bull says, gold up means the world is ending. That's too dramatic. Gold can rise for several reasons. Inflation fears, geopolitical stress, reserve diversification, real rate shifts, weaker confidence in fiscal management, or a messy combination of all of them. Gold is a signal, but it is not always a one-cause signal. Still, the signal today is hard to ignore. If you're successful, share your success story in the comments so others can stay motivated. Now let's bring this down to the level of an ordinary saver. Cash is useful. Cash gives flexibility. Cash helps you survive emergencies and take opportunities. But long-term cash held as a strategy can become a silent loser if inflation runs hotter than what your savings earn. That is not ideology, that is arithmetic. So the question is not whether to have cash. Of course you need some. The question is whether you understand what cash is vulnerable to over long periods. Gold, for many people, sits in that conversation as insurance more than speculation. Physical gold gives direct ownership, but it comes with storage and security issues. Gold-backed funds are easier and more liquid, but they reintroduce financial system exposure. Mining stocks can give you leverage to the gold price, but they are businesses first, with operating, political, and management risk layered all over them. Silver can be compelling, but it behaves differently because industrial demand matters much more. You need to know which game you are actually playing rather than lumping everything together and calling it gold exposure. That distinction matters, because the biggest misunderstanding in this whole topic is thinking gold is supposed to behave like a tech stock. It isn't. It has a different job. Gold is less about maximizing excitement and more about preserving optionality when the credibility of paper systems gets a little shaky. It doesn't replace productive assets. It doesn't replace cash for daily life. It plays a different role in the architecture. And once you understand that role, you stop asking only whether gold is overbought this month. You start asking bigger questions. Why do central banks still want it? Why did its reserve share rise so sharply? Why did overall demand just hit record territory? Why are U.S. investors suddenly showing much stronger appetite for it? Why do institutions that understand liquidity, sanctions, war, and debt at the highest level still keep some of their trust parked in a metal that cannot be printed? Those are not small questions. So let me ask you two things. First, do you see gold primarily as money, as insurance, or as a trade? Second, what do you think erodes trust faster over the next few years? Inflation, geopolitics, or debt? Because if you don't understand gold, you may not actually understand what your money is sitting inside. And that is the whole point of this video. That's why understanding gold is really about understanding trust, discipline, and time. Not just chasing another headline, not panic, not doom, not some fantasy that every paper system dies by breakfast. The point is to understand the measuring stick before more people realize the measuring stick itself has been under pressure for a very long time. Gold is not perfect. Gold is not magical. But gold is one of the oldest financial warning lights humanity has ever had. When it keeps flashing, I think it's worth paying attention. Thanks for watching. Subscribe if you haven't already. And remember, this is for education only. I'm sharing a framework so you can think more clearly and make your own decisions, not giving personal financial advice.